Well, good evening, everybody, and a very warm welcome to the Sheikh Zayed Lecture Theatre. I'm Tom Gosling, Professor of Practice here in the Financial Markets Group at LSE and Director of the, to be launched tonight, initiative in sustainable finance, which is being established as part of the Global School of Sustainability. Feel free to throw your hats in the air, wave your order papers, stamp your feet, and generally cheer. So tonight's going to be organised in three parts. So first of all, we're going to hear more about the Global School of Sustainability from Professor Lord Nicholas Stern, and more about the initiative in sustainable finance from Professor Amil Dasgupta. And then second, at around 7 o'clock, we're going to have our keynote academic lecture from Professor Dirk Jenter, which will be followed by a practitioner discussion. And I'm delighted to say we've got some excellent practitioners in Catherine Davidson of Baillie Gifford and Ben Yeo of RBC Global Asset Management. I'll say a little bit more about all of our speakers later, and there will be an opportunity for audience Q&A at the end of the lecture. And then third, we will close at around 8:30, and you're very welcome for drinks and canapes, which will be served where you came in at the back of the lecture theatre. So without more ado, I'd like to introduce Professor Stern. And I have to say, he truly needs no introduction. Professor Stern shot to public prominence with the publication of the Stern Review on the Economics of Climate Change in 2006, a review produced for the UK government, and before and since has been a tireless exponent of the application of social sciences to charting a more sustainable path for society. And that's a role he's fulfilled with distinction here at LSE, most notably through chairing the Grantham Institute, but also amongst other activities. If I was going to talk about all of Nick's accomplishments, we'd be here deep into the night, so I think the most relevant thing for me to say in relation to this evening is that he also chairs our Global School of Sustainability, a new venture which he has put an enormous amount of work into bringing into being with our generous donor Lei Zhang. And so, Nick, over to you, please, to say a little bit more about the Global School.
Thank you very much, Tom. I've been doing climate change for 20 years and development economics for 55 or so years, and that's important because the whole question of climate change and sustainability is part of the story of development. It's not some separate subject. So let me say something very quickly about the school, the Global School of Sustainability, then sustainability, and then sustainability is all about, if you think about what it means, it's about capital investment and thus the finance for investment. So when we're talking about finance here, finance for what? Finance for the investment that's going to drive sustainable growth. So that's the story. The Global School of Sustainability, well, we had our first discussions with the donor about 3 years ago. And then about 2 years ago, he came along and a group of us from different parts of the LSE, that's critical. This is about all the parts of the LSE to exchange ideas. And then a year after that, last May, we signed up. And then we announced in September, quite quietly but publicly. And then we started in January. Now, a key part, and actually the only part that the donor Lei Zhang emphasized specifically was finance. Why? Because he saw this, and his language is, and this is one of his sentences, sustainability is prosperity. And you don't run down the old until you've invested in the new. It's an investment story, and that's what he does. He builds batteries, he builds solar plants, he creates green hydrogen and then green ammonia. He uses, puts the AI systems together in order to run all these things. So that's the way he sees it, as an investor, but an investor that's all about change. And sustainability then, that's a quick background of where it came from and why the interdisciplinarity is so important, why we need the whole school involved. That'll be underlined yet again when I take a working definition or offer a working definition of sustainability. Sustainability is to offer the next generations opportunities at least as good as the ones we had, on the understanding that they behave in the same way to the towards the generations that follow them. What shapes the opportunities? It's a slight translation, by the way, of the Brundtland definition. She spoke about needs. I think the opportunities are a better way of looking at it. But it's not a revolutionary notion of sustainability. It's a modified one, but I think in the natural way. So what determines the opportunities of the future generations? It's the endowments that they have. What endowments? It's the physical capital. It's the human capital, health and education. It's the natural capital, all our land and our trees and our water and our forests and our oceans and so on. It's the natural capital, and it's the social capital. Now, social capital is less easy to define, but it's the set of institutions and relationships and behaviours and distributions, including of power, that shape our society, including, of course, shaping the environment for investment. So this is a story, then, of a notion of sustainability, which I hope is attractive, and indeed I hope we're seen as a moral obligation. Secondly, from that definition of sustainability, immediately the story of the endowments and the capitals comes through. And so if you're talking about capital and you're talking about augmenting capital, you're talking about investment. And indeed, of course, in the case of natural capital, you're talking about avoiding disinvestment. Okay? And of course, social capital can be destroyed very easily. I think you can think of one or two examples, since January. So this is capital that needs looking after, but it needs to be augmented and invested in. So all this then is about creating the conditions for sustainable investment. And that's a story of different parts of society, including, of course, government, but also the private sector and civil society and the unions, getting together to create an environment where the right kind of investment can take place. And an investment at a pace and scale that the problem demands. This next 10 years will be, in many ways, decisive for our future. We have to change, and we have to change very quickly. So creating that environment is fundamental. But also, of course, investment needs finance. Different kinds of investment need different sorts of finance. Most electricity generation, provided that there's a credible market for the electricity, would now be in the private sector. A lot of adaptation and resilience investment, of course, very much part of the story. A bigger fraction of that would be in the public sector. Natural capital is something also more likely to be public. So the question of investment is the environment for investment, but the finance for investment has to be fitted to the kinds of investments you're talking about. And I've already described those investments taking place across the whole waterfront of the economy, and waterfront's all right because it covers the ocean as well. So that's the story, and that's why the initiative in sustainable finance is so important. And it is the only area, actually, that the donor specified. He sees this as right across the social sciences as a whole, that the difficulties now are no longer technological. We need lots more technological advance, and it's coming, and we have to encourage it. The difficulties are now the economy, society, and the politics. That's why the LSE is the right place. And it's the right place because we are a truly global university. So this is the right thing, right time, and the finance is absolutely at the heart of it all. That's why I celebrate the initiative and looking forward very much to working closely with it. Thank you.
Nick, thanks so much for those words. I now have to invite up the man that I now answer to. That is Professor Amil, the boss, Dasgupta. Amil is a professor of finance here at LSE. He's also academic director of the Sustainable Finance Initiative, and he's also director of the Financial Markets Group, which is LSE's flagship research centre in finance. He's got a distinguished research track record in the areas of financial markets, corporate governance, institutional investors, and he's also got overall responsibility for the theme of creating sustainable finance and business within the Global School of Sustainability. So, Amil, what is the initiative in sustainable finance, and what are we planning to do? Or what are you planning to get me to do, I suppose, which might be a more accurate description.
Thank you so much, Tom, and thank you, Nick, for your inspiring remarks. Look, good evening, everyone. Look, I have to say this at the beginning. So I think one of the key secrets to being recognized as a successful public speaker around here is not to speak in public right after Nick Stern has. I knew this, but somehow my lovely team, my new colleague Tom Gosling, who just introduced me, and now chair for the evening, and my wonderful center manager, Anne Law, who's been doing so much work in the background for making this happen. Normally my guardian angel, but had stuck me right after Nick. Now, I have been working everyone quite hard in the past couple of months, but I wonder if my team is trying to tell me something. Okay, so wonderful to see you all here. As Tom has pointed out, I'm privileged to be leading the development of the sustainable finance theme of the LSE's new Global School of Sustainability, GSOS, as we call it, made possible by alumnus Lei Zhang's transformative gift to the school. This means I get to work with Nick and help him on this aspect of GSOS, which in itself is a wonderful experience. Thank you, Nick, for being so patient as I learned the ropes and so encouraging. So within the sustainable finance wing of GSOS, we're starting a brand new research center, currently entitled An Initiative in Sustainable Finance. That's what this evening is about. Tom's main role, when he isn't scheming with Anne to demolish my public speaking career, will be as director of the center. Welcome to the LSE, Tom, and thank you for all the great work you've already been doing with us. So our center's work is going to be principally in the role of private finance in the net zero transition. So why private finance? Obviously, to state the obvious, the transition cannot happen without private finance, and that's before the urgency of defense spending became clear. But there's actually something more. It's not just the counting. There's something deeper. Even at this arguably late stage of the process, one might argue, the transition timeline is not ideally suited to the political cycle that governs so much of public policy. And as we're discovering of late, the political cycles of different countries interact with each other, making public policy even less of a panacea. In contrast to public policy, private capital, to a significant extent, is driven by contractual incentives. And while there's wide variation in contractual incentives, some of such contractual incentives are almost definitionally incorporate a long-term perspective. Take, for example, pension funds. Long-term asset owners, such as pension funds, are arguably more likely to internalize the impacts of climate risks into their portfolio and actions than policymakers answerable to the political cycle. Long-term asset owners' incentives to think long could potentially drive flows and thus critically impact the capital allocation system. Now, I'm not naive. I'm not going to argue that any private sector organization is entirely immune to political trends. Not at all. Yet, the recent examples of 26 large pension funds around the world demanding that their asset managers engage with portfolio companies on climate risks, and perhaps most spectacularly, the People's Pension moving £28 billion from their existing asset manager on the grounds of misalignment on climate goals, are both, to put it mildly, striking examples. Private capital can sometimes speak very loudly. The actions of these pension funds strike me as being a clear case of how, in principle, the long-term outlook of some financial institutions can drive flows in the asset management sector, undoubtedly influencing incentives in the rest of the sector. More broadly, there is an intricate ecosystem incorporating end investor preferences, fiduciary obligations, asset manager mandates, capital flows, and concomitant responses and actions, all within the private financial sector. This is exactly what we're most interested in the initiative in sustainable finance. This is an area in which the LSE's academic community of financial economists has very significant strengths. Several of us have been working on incentives and impact of institutional investors, good and bad. We don't take any particular side for years. Indeed, the initiative is supported by the significant intellectual strengths of the Financial Markets Group, the LSE's flagship research center in financial economics, set up by Charles Goodhart, who's here, and Mervyn King, the former governor of the Bank of England and our colleague in the Department of Economics, in 1987, and the center that I'm fortunate to lead today. And it is also supported by specific ongoing research programs within that center. I want to mention specifically the Responsible Investing Initiative, funded by the generosity of the Brown Gonzalez Foundation. Andy Brown is here today, so thank you, Andy, very much for your support. How will we operate? Perhaps differently from many other institutes or centers in this space. After all, the LSE is an academic institution, and our motto is to know the causes of things. So we'll certainly not fail to take a rigorous and academic approach. We may well be a little bit more nerdy than most, and proudly so. But we also recognize on this issue, more than most, living inside an ivory tower is not desirable. We have much to learn from practitioners, and hopefully our work will support theirs as well. So in all our activities, we'll take our convening role to heart and engage in an active conversation with those outside the academic community. So there are many, many things that we're going to be doing, and I won't take you through all of them this evening. Instead, let me highlight to you just two specific things that we're going to do. The first emphasizing a bottom-up micro approach, and the second, a top-down macro approach. So from the micro perspective, that is, focusing on incentives at the level of individual firms or individual funds, we'll undertake a work stream on the effectiveness of sustainable investing. What works and what doesn't in sustainable investing? Is it that sustainable investing is most effective through a cost of capital channel, whereby firms are incentivized to go green by being rewarded by lower cost of capital if they do so? Is it instead engagement by concentrated equity owners that has the largest effect? Which one of these routes do institutional investors take? Which one should they take? Or should they instead focus on trying to influence the system of rules that govern the space through lobbying activities, something completely different? Okay. I can confidently suggest to you that while some progress has been made in understanding the answers to these questions, much remains to be done. So we're going to be organizing a working group of academics and practitioners through the remainder of this calendar year and beyond, bringing together the best academic researchers and industry experts to discuss these questions and build a deeper consensus. Our efforts are going to culminate in one of the initiative's flagship annual events, the Sir Oliver Hart Public Lecture and Conference in December. We've already succeeded in securing Professor Luboš Pastor of the University of Chicago, a globally leading academic in sustainable investing, to give the main public lecture. I hope to see many of you there Thursday, the 4th of December. Further announcements and details forthcoming, I believe, in this room. This will be followed by a one-day invitation-only academic conference, but that will also feature a group of senior practitioners. Let me now turn to the macro perspective. It's widely recognized that there is an enormous gap between transition finance requirements and what is being delivered globally, with a particularly stark gap in the so-called Global South. A key problem is how to crowd in private sector investment. There is an urgent need to scale up blended finance, the deployment of public or philanthropic capital to mobilize private capital. I'm pleased to say that one of our macro initiatives will be the launch of a blended finance lab. While the need for blended finance has been recognized, the market is smaller than it needs to be by at least an order of magnitude. Several barriers prevent it from scaling: the lack of investable deal flow, suboptimal use of blended finance tools by concessional investors, the lack of marketplace to enable interaction between public and private actors, the lack of institutional investor orientation towards this kind of investment. The LSE has extraordinary strengths in this area. For example, the Global Impact Group being convened by Nick, and the work on transition finance being undertaken within the Grantham Institute. The aim of the Blended Finance Lab is to complement the strategic and public policy work with regular, on-the-ground dialogue about how to address the practicalities of getting blended finance done, with a particular focus on how best to secure private sector participation. We're delighted to be working with Harold Walcota and Robert Van Swieten of Route 17, who many of you know, who will be helping us establish this important initiative. Harold is with us this evening, and if you have questions, he'll be happy to explain more over drinks. Finally, let me turn to our academic output. Our website has gone live, so we'll put up the link at the end of this evening. On it, amongst other things, you'll see several academic papers already produced by my wonderful colleagues, not just in finance, so that will be our focus, but also in accounting and law. Each paper, over time, will be accompanied by a podcast prepared by Tom, explaining it in terms accessible to the wider world. And speaking of these papers, this evening you're going to hear one of these. My friend and colleague Dirk Jenter will present his paper, on which Tom is also a co-author, to you right after I'm done. Ultimately, though, while we're going to be doing lots and lots of stuff, and we're certainly not new to convening research and policy initiatives at the LSE, this is a new venture, and we rely very much on all of you, your expertise, your engagement, for the students amongst you, your enthusiasm and your curiosity, and from all of you, your goodwill towards us. So I very much look forward to interacting with many of you and drawing upon your collective wisdom in the months to come. Thank you very much.
Well, thanks very much, Amil. And as Amil described, I mean, one of our objectives is to bring together leading academic research on sustainable finance with practitioner perspective. So I'd like to invite Dirk, Catherine, Ben to come up to the stage now. Our keynote academic lecture is from Dirk Jenter, Professor of Finance here at LSE, who's a widely published and prominent authority in the areas of corporate governance topics. Dirk tonight will present on his paper, Sustainable Investing, Evidence from the Field, which won the Best Working Paper Award at the UNPRI Academic Conference in November last year. I'm also pleased to say that we have two excellent and highly experienced portfolio managers to help us to discuss the paper. Catherine Davidson is an investment manager for the Baillie Gifford Sustainable Growth Strategy and contributes to the firm's sustainability activities more broadly. Prior to that, she was a portfolio manager in global equities at Schroders for 14 years, where she played a key role in establishing that firm's sustainability strategy and fund range. Since moving to Scotland to be with Baillie Gifford, Catherine's been burnishing her sustainability credentials by refurbishing a 200-year-old house to modern energy standards. And she made the mistake of admitting to me that she has installed a heat pump. And if anyone knows my unnatural fetish for low-carbon heating systems, you will warn her never to have dinner with me. Ben Yeo is a senior portfolio manager in global equities at RBC Global Asset Management, where he is both a healthcare and sustainability expert. He also chairs Royal London Asset Management's Responsible Investment Committee and wrote the course and the textbook for the CFA ESG certificate. Ben is also a playwright, performance artist, does a very good show on climate change, and a prolific arranger of social networking opportunities, the next one of which is on the 17th?
Yeah, next week.
Next week. So look for that, and I'm sure you'll all be welcome. So Dirk will present his paper. I will then ask Catherine and Ben to provide comments on it. Following some discussion with the panellists and Dirk, I will then throw it open to the audience for a short Q&A before we finish. So Dirk, over to you.
Thank you so much, Tom, for this very generous introduction, and also from me a very warm welcome to all of you to LSE and this absolutely wonderful launch event. Now, Amil said earlier that we at LSE are a pretty nerdy bunch, and I guess that's why they chose me to present some of my academic research. Now, I'll try to keep it as unpainful as I can, but it will be an academic talk. So we'll talk about genuine academic research for the next 30 minutes or so, under the bold assumptions that I managed to get the clicker to work. Oh. Okay, this seems to be rather frozen. So maybe there won't be an academic talk after all, and we can go directly to drinks. So I might need some tech support here because, okay, hey, I think I just got it to work. Excellent, okay, I found the right clicker. Oh. I'm usually known to be loud enough without a microphone, but fair enough. Let me move that down a little bit because I know I'll otherwise blow most of you away. I've broken speaker systems before. All right, so once again, This is a genuine academic paper. It is joint work with Alex Edmonds, which I'm sure many of you know, if I'm allowed to say my former student, but only by just a couple of years, and our very own Tom Gosling. And the title is Sustainable Investing, Evidence from the Field. It's really a survey project, a survey of active equity portfolio managers, and I believe quite many of you have participated in that. If you did, thank you so much. The big question we're trying to ask in this project is, will the asset management industry help make the corporate sector more sustainable? Will it help improve the environmental and social performance of the corporate sector? And I probably don't need to explain to anybody in this room here that sustainable investing has become a big deal, has become incredibly popular. And whenever people say that, they throw around really big numbers, so let me do the same. As of just a few years ago, almost 3,500 investors managing 120 trillion in assets had signed up to the UN Principles for Responsible Investment. And that gives us hope, right? That genuinely raises the hope that maybe the asset management industry can genuinely improve the environmental and social performance of the corporate sector. But when you think a little bit about that, at least when we were thinking about it, we realized that, well, that actually requires a few things. At a minimum, probably one of three things need to be true. Either our asset managers, our portfolio managers need to genuinely care about environmental and social performance. So they need to have it in their objective function. Or if that's not the case, they have to believe that current ES performance is somewhere still below value maximizing levels. So if we're still operating with the old objective function, just financial value, then if companies don't yet do enough ES to maximize financial value, well, again, we're in business. And if none of these two, then maybe somehow we can get the asset managers to take ES performance into account because we're imposing a range of constraints on them. So we want to find out whether any of these things are true. Now, naturally, observing asset managers' objectives, beliefs, and constraints is incredibly difficult. This is not something where you can download some clever data from some database, run a bunch of regressions, and find out the answer. Which is why we decided to just go to the horse's mouth, and not that I would ever call any of you horses, but we actually just decided, well, let's ask them. Let's do a survey of active equity portfolio managers and simply ask them, what are your beliefs? What are your objectives? What are your constraints when it comes to environmental and social performance of companies? Do you pay attention to ES performance? And if you do, why do you do it? Is it purely for financial reasons? Is it because you would like to have impact, because you're trying to change the world? Is it because of your clients? Are you simply trying to reflect your clients' preferences, wishes, and desires? Or has somebody imposed a bunch of constraints on you which force you to take ES performance into account? Now, probably most importantly, are you willing to trade off financial performance for ES performance? So are you willing to accept worse financial performance if a company promises to behave better, to be more environmentally or socially responsible? And finally, how does your thinking about ES performance affect your decisions, and specifically portfolio selection, engagement, and voting? So that's the goal. Let's see how far we manage to get. It's a very ambitious agenda, and obviously it's just a survey, but I hope we'll be able to answer at least partly some of these questions here. So just before we get to the results of some basic data about the survey, the implementation of the survey was pretty straightforward. We simply tried to email every single active equity portfolio manager in the world. And if you're an active equity portfolio manager, you probably got one of our emails. If not, you'll be in our next survey. Please contact me after this talk. If you're an active equity portfolio manager, chances are pretty good you got somewhere between 1 and 12 of our emails. If it was more than 5, I sincerely apologize. But we just tried desperately to reach you by using every possible email we could remotely unearth about you, probably some you didn't even know you owned. In the end, we managed to get responses from 509 active equity portfolio managers pretty much across the world, 479 of whom completed the entire survey. So once again, if you're in that group, thank you so much. A little bit more data. 290 of our respondents run traditional funds. So traditional fund here simply means a fund that's not self-identified as a sustainable fund or ES fund, ESG fund, SRI fund, so anything like that. And obviously the remaining 219 run explicitly ES sustainable or SRI funds. Now, for those of you who are familiar with the industry, that obviously means we've got a bit of an over-representation here of the sustainable investors in our sample, which means I'll usually show you the results broken down separately by the two groups rather than aggregated, because I don't want to misstate what the overall asset management industry looks like. 223 of the funds are US funds, which for us just means marketed in the US. Doesn't necessarily mean that the manager is sitting in the US, but marketed in the US. The others are mostly from the European Union and the UK, but we have Australia, we got New Zealand, we got Hong Kong, we got Japan. So we really got a very, very nice global mix in there. All right, and with that, let's just dive into the results. As I've said in the beginning, we're interested in the beliefs, the objectives, and the constraints of those portfolio managers. So let's start with the beliefs, which are probably the most exciting aspect of the survey. Really what we're after here is, do our asset managers believe that the S performance matters? And if so, why? And so to get us to get our respondents in the survey warmed up about this set of questions, we started with something very, very broad. We asked them to rank the following 5 drivers of long-term shareholder value by their importance. And the 5 drivers we offered were strategy and competitive position, operational performance, governance, corporate culture, capital structure, and the S performance. There were actually 6, I miscounted. All right, and just to explain how this works, because every table is going to look pretty similar from here on, I threaten it's going to be an academic paper, there will be tables. I will always order responses by their popularity. So the most popular thing on top, the least popular thing on the bottom. Obviously, in the actual survey, the responses were randomized. So I'm just ordering in that manner to make it a bit easier to read. And we purposefully included some things in there which should probably all agree are obviously very important, like strategy, competitive position, operational performance. But we purposefully also included governance, often grouped together with E and S into ESG, even though few of us believe that actually makes sense. Corporate culture, sort of another soft factor. Capital structure, something that us corporate finance types have been thinking about for a long time. We don't actually believe matters all that much on the margin. And then obviously ES performance. And the big takeaway from this first question is just ES performance just consistently for almost every respondent ranked towards the bottom. And I want to emphasize that was true for both the sustainable fund managers and the traditional fund managers, which is just a little bit sobering. Now, at the same time, I really don't want you to take away from that fund managers believe that the S performance doesn't matter for 2 reasons. Number one, this is not about absolute importance, right? This is just about relative importance, and maybe all of these factors matter. And in fact, that is the case, because on the next question, we will ask about absolute importance of ES, and many fund managers will be reporting that, yes, it does matter in absolute terms. But the other reason why you really shouldn't take away from that ES performance doesn't matter, or that fund managers believe that ES performance doesn't matter, is because we took a bit of a beating in the free text field associated with that question. Now, I should have mentioned already that every question came with a free text field where the respondents were allowed to tell us what they think about the question, add any additional information. And fortunately, many respondents did. And in many of the free text fields, they told us, you academic eggheads, that question doesn't make any sense. You shouldn't have asked that question in that manner. And it was especially true for this question here, and I believe rightfully so. Because, the message we really got in the free text fields was, this is much too crude a way of asking this question. Look, you can't rank these things against each other. They're all interlinked, they're all connected. ES performance might very well affect competitive position, the operational performance. ES performance signals something about corporate culture, and obviously certain aspects of ES performance will be super important in some industry and completely irrelevant in others. All of which is eminently fair and obviously correct. And by the way, that reflects a theme that's sort of going throughout the entire survey, that many asset managers think about ES performance in a very, very sophisticated and very differentiated manner. Sort of this crude notion of, oh, good ES, bad ES is way too crude for the way, is way too crude a description of how many asset managers think about this. So clearly not a great way of asking the question, we can probably all agree, but still, when you put the proverbial gun to people's heads and saying, look, rank them against each other, ES performance does come in on the bottom, which is, I think, somewhat interesting. I certainly didn't expect that to be the case. Now, let's start thinking about absolute importance of ES performance. So the next question was exactly about that. How material is ES performance on the following dimensions for long-term value? And we broke ES performance down into 8 different dimensions, from employee well-being, consumer health, welfare, privacy, all the way down to demographic diversity. Just to explain how this works, 0 means immaterial here, so it was a 0 to 4 scale, 5 different options. 0 means doesn't matter at all, 4 means matters a lot, highly material. And the message here really is that lots of these ES issues got a lot of support. So 78% of the traditional investors rated at least one issue as a 3 or 4, so as important or very important. So once you sort of get a little bit more into the details, into the nitty-gritty, a lot of asset managers, including traditional ones, very much believe that ES performance is material, financially material for long-term value. And probably quite unsurprisingly, the sustainable investors rated everything quite a bit higher, in essence thought pretty much everything here is material. The biggest discrepancy between the two groups was sort of on the environmental issues, and the largest gap, interestingly enough, was on the greenhouse gases right here in the middle, which the sustainable investors rate most important and the traditional investors not so much. And that's something you're going to see a few more times in the survey. All right, so now all of that was about long-term value. Now value, I don't need to tell that to the asset managers in the room, long-term value is not returns, right? Something might be very, very financially material for long-term value, yet may have absolutely no effect on returns if it's already fully priced in by the market. So the next question, unsurprisingly, was about returns. So we asked, do you expect good ES performers to typically out or underperform in long-term risk-adjusted shareholder return? Bit of a mouthful. Do you think the good ES performers will have positive or negative alpha going forward? Notice we asked about good ES performers here because in the beta testing, which we did extensively with some of you here in the room, and thank you once again to you willing to do that with us, we learned that people don't necessarily think about good and bad ES performance symmetrically. So we kind of broke it up into 2 questions. I'm gonna emphasize this one here, focus on this one here about good ES performers tonight. The scale now is a little bit different, just to mention that. For -2, I expect the good ES performers to strongly underperform over 0, while they're priced about correctly, no alpha, to +2, strongly outperform high positive alpha. And showing you the results separately from our traditional and sustainable investors. And remarkably, we are getting a lot of support for outperformance, which again, just to reveal my own honest priors, I didn't really expect. So 45% of the traditional and 73% of the sustainable investors expect good ES performers to outperform. We get very little support for the notions that good ES performers are already overpriced, which is again something that I didn't really expect. So I had my money on getting quite a bit of support here. I was expecting many of the traditional investors to tell us that, look, all of these sustainable folks, they have been overbuying the green stocks, the good companies. As a result, they're already overpriced. I expect them to underperform going forward. Well, it tells you how much I know. We really got almost no support at all for that. So an interesting result to us. And then finally, it's remarkable how much heterogeneity in the beliefs there is. And it doesn't split neatly just along the sustainable versus traditional demarcation. Right? I mean, to say the obvious, 45% of my traditional investors here believe that the good stocks will outperform. At the same time, 27% of the sustainable funds don't believe so. Right? So this is something to keep in mind when you're picking your fund. If you're the People's Pension Fund and you're picking your asset manager, what you're actually getting in terms of investment style doesn't just depend on the label, traditional versus sustainable, but very much depends on the actual beliefs of your asset manager. And you might be getting quite a different investment style or a different investment product as a result. Now, let me get to the final question on the, apologies. Before I get to the final question, we tossed in a follow-up question. All of those here who responded will outperform, we asked the rather obvious question, why? Why do you think that the good ES performers will outperform in the future? And there again, we were extremely surprised by the answer. So again, let me just state the question properly. Why do you think good ES performance leads to long-term outperformance? So -2 now means strongly disagree, 0 means neither, +2 means strongly agree. And almost every single respondent gave a 1 or 2, so a yes or a strong yes, to good ES performance is correlated with other characteristics that cause long-term outperformance. So that for us was a completely unexpected and frankly stunning result. So the causal driver of the outperformance of good ES stocks isn't the good ES, but it being correlated with other drivers. What other drivers? Well, reading the free text fields and asking a lot about that in a number of post-survey interviews we did with some of the respondents, it's correlated with good management, good governance, good culture. So a typical remark in the free text fields was, good companies have good ES. And if you see good ES, it is a signal of a good company. So to us, that was, again, surprise and really interesting. And if some of you have views on why that was the answer that almost everybody chose, I'd love to hear about it later on in our discussion. And again, I just want to mention that there's once again, a lot of heterogeneity in beliefs. Now, asset managers' beliefs about why we're getting outperformance of the good companies. Obviously, we have the correlation point up here, but many of the respondents still supported notions of mispricing, so good companies are simply underpriced, and also the notion that because of demographic and other shifts, the demand for good companies will be going up over time, which will be pushing their prices up over time, which is what I believe Larry Fink of BlackRock has been arguing for many years. All right, with that, let me get to the last question in the belief section, which is, how do you think about the current ES performance of companies solely from a shareholder value perspective? So in other words, if you as an asset manager look at the companies in your portfolio, do you want them to improve the ES performance in order to increase shareholder value? Do you think they're doing it roughly right? Or do you actually want them to be, maybe very quietly, to be a little bit worse, because that would be maximizing shareholder value? And we again offered them the exact same 8 ES issues that we've already looked at earlier. So again, here the scale is from -2, significantly underinvest. So we believe they should be doing a lot more on these dimensions. 0, they're getting it about right. +2, they're already doing way too much. So let's just focus for a moment on the averages here. Notice those are very close to 0, but lean just a little bit on the positive side. So there's clearly some notion here that there's already a little bit more over than underinvestment. So if anything, companies are already doing a little bit too much on the ES side to maximize shareholder value. But I believe the bigger message here is that the modal response, so the most popular response for 7 out of these 8 ES issues is neither, which is to say companies are getting it about right. Now, if you're interested in what's the remaining one, it's interestingly enough, again, greenhouse gas emissions. So that's where the most popular response was, companies are already doing a little bit too much. But leaving that aside, it's pretty obvious that, obvious maybe too strong a word, but coming back to the initial motivation, right? Can we expect the asset management industry to drive improvements in the asset performance in industry and companies? Do we expect the asset managers, the portfolio managers to man the barricades and shout at companies to improve their ES performance? Well, based on that, probably not so much, because at least from a shareholder value maximization perspective, most asset managers believe companies are already doing too much, if anything, maybe a little bit too much. All right, so that's the bit about beliefs. I promised something about objectives and constraints, so let's quickly get there. Objectives, that's only going to be one question, but in some sense the most important one in the entire survey. Are you willing to trade off financial performance and ES performance against each other? Now, we asked a bit of a monster of a question. Let me explain it. So the question we asked was, how much long-term risk-adjusted shareholder return would you tolerate a company sacrificing to improve its ES performance? We asked in this manner to really invite somebody saying, yes, I'm willing to at least tolerate a company doing something. Because in the beta testing, we learned if we asked the more direct question, are you willing to sacrifice? In the beta testing, we didn't get a single asset manager to say yes to anything. So we kind of tried to soften the question more and more and more in the beta testing to get some positive responses. That's the softest thing we could come up with, and it still didn't work very well. So the options we gave, 0, I would not tolerate any sacrifice, and then all the way down to more than 50 basis points, half a percentage point per year. Let's focus on the ones who actually said, yes, I'm willing to tolerate some sacrifice of financial performance for better ES performance. And frankly, it's not very much. So 24% of the traditional, 30% of the sustainable investors said they would tolerate any sacrifice at all. But notice that the bulk of these responses sitting here in the 1 to 10 basis point range. So I'm a more old-fashioned corporate finance guy. If you think of that from a cost of capital perspective, that's nothing, right? That's not going to change corporate behavior in any meaningful way. And pretty much nobody is willing to seriously sacrifice anything down here. Why not? Well, the free text fields couldn't have been any more clear, and we got the same message both in the beta testing and in the post-survey interviews. We're not allowed to. We're not supposed to. I mean, many of the responses we got were very much in the free text fields, very much along the lines of, you shouldn't even ask this question. I have a fiduciary obligation to my clients, to my investors, to maximize portfolio value. I'm not allowed to do anything else. And that was a very, very consistent theme throughout. And again, that's a little bit sobering, right? If you sort of think of sustainable investing as, oh, they have a different objective function. No, they don't. And I could give you the breakdown between, you have the breakdown even traditional and sustainable ones. Even the sustainable, there's remarkably little difference between the two, right? I mean, that was no surprise to us at all. This column here was very much a surprise. It's something we didn't really fully understand before we did the survey. Now, I need to comment on that because that's also something we really didn't expect. So the most popular response for the sustainable investors and the second most popular for the traditional one was actually no sacrifice is necessary since there is no trade-off. Now, if you're a trained economist like I am and many of us here in the room are, what? There's always a trade-off. What are you talking about? So in all honesty, when we read that, we thought, well, wait a moment, people misunderstood the question, or we didn't ask the question right. So then we really dug into the free text fields, we read every single comment, we interviewed lots of people, and no, people did not misunderstand the question. But there's a very subtle way of interpreting that response, an important way. Lots of asset managers probably very correctly believe that many companies still have ways to improve their ES performance, be a bit nicer to your customers, be a bit better to your employees, that would not sacrifice shareholder value. So you can still be better in specific projects on certain dimensions without sacrificing anything. And very sensibly, asset managers want companies to do exactly that. And then when we pushed our response a little bit more on, well, and then once that's exhausted, would you be willing to tolerate any sacrifice? The answer was almost uniformly, absolutely not. What are you even talking about? Remember, I've got a fiduciary duty to my clients. So I can't prove that in a rigorous manner, but I believe that we should kind of group pretty much all of these responses here with the top group here saying, yes, obviously, as long as they can still do something that doesn't sacrifice shareholder value, I very much want them to do that. But once we reach the point of an actual trade-off, please stop right there because I really don't want you to go beyond. All right, now that leaves us almost with a bit of a puzzle. Right? So if sustainable investment managers don't have beliefs that are all that different from the traditional fund managers, if they haven't really changed their objective function, what is sustainable investing? And I believe the answer, and I really only understood this through the survey, is it's all in the constraints. Sustainable funds are funds that are much, much more constrained in what they can do than traditional funds. So let me just show you one of the constraint questions, and we have a series of them in the survey. We didn't want to ask a very abstract question about do you have ES constraints on your investing behavior, because people would have interpreted all kind of things into that. So we settled on asking very specifically about the 4 constraints that we learned in the beta testing are most relevant. Have firm-wide ES policies, your fund mandate, your client's wishes, or concern for your reputation or sustainability rating ever caused you to do one of the following or any of the following. And then we just gave them the kitchen sink of all kind of things you might do because you are constrained. From avoid stocks that would improve portfolio diversification all the way down to hold stocks we believe would underperform. And the remarkable thing is how constrained asset managers feel. 61% of the traditional and 84% of the sustainable investors reported to us here that they changed their investment or engagement or voting behavior because of ES constraints. And the most common outcomes or the most common consequences of that were we had to avoid stocks that would have improved portfolio diversification, we had to avoid stocks that believe would outperform, and we had to engage with companies on ES issues that we do not believe to add shareholder value. So really, sustainable investing is largely driven by these constraints, not changes in the objective functions, not changes in beliefs, but largely by those constraints. And probably most surprising to me, 61% of the traditional investors these ES constraints. So I thought it would be much more bipolar. Everybody on the sustainable side, yes, I'm obviously constrained, look at my fund mandate. Everybody on the traditional side, what are you talking about? And in reality, it is much, much more amorphous is maybe one way of putting it, or just the two are much more similar than we expected going into that survey. Now, there's a little side aspect that I want to mention for a moment because it's either fun or depressing depending on how you look at it. On the sustainable fund side, we're getting about a third of them tell us that their fund mandates, their constraints get in the way of actual sustainable investing. So 30% of the sustainable investors said we had to avoid owning an ES leader in a laggard industry, right? Presumably because the fund mandate didn't allow them to own the laggard industry. Again, about a third of the sustainable funds said we had to avoid owning an ES laggard whose ES performance we could have improved, right? I mean, that would have been impact investing. We couldn't do it because our mandate, our constraints didn't allow us to do that. So we then just dug very briefly into what specific constraints were those, right? Just remember on the previous one, we just kind of bunched all of these constraints together. Then anybody who answered yes to any of these, we followed up with a question saying, so which specific constraints were forced you to do those? And there's a probably unsurprising differentiation between traditional and the sustainable investors. For traditional investors, it's largely the firm-wide policies and the client wishes. Again, the firm-wide policies is something that I didn't fully appreciate before doing the survey. So you're looking at a traditional fund manager, you look at the fund mandate, and you're saying, well, there aren't very many constraints in there, yet the fund manager will still report to us that they face ES constraints because they are company-wide constraints. We don't do weapons manufacturers. We don't do white phosphorus. We don't do A, we don't do B, we don't do C. And that, interestingly enough, means if you're an owner of a traditional fund in fund management company A versus fund management company B, you might be getting a quite different product because these two companies might have imposed different sets of constraints on all the funds in the organization. And the other interesting insight here is that traditional fund managers still very much faced capital owner wishes, client wishes, pension funds, endowments, and others that put ES constraints on them. Again, something we didn't fully appreciate before. On the sustainable side, unsurprisingly, the number one driver of the constraints is the fund mandate. That pretty much is what defines a sustainable fund. All right. Now, for the academics in the room, and I realize there are probably not too many here tonight, but let me just very speak to those of you who are writing models for a living. What all of these results put together suggests to us is a very specific model of sustainable investing through delegated asset management in which funds maximize returns, just like in our traditional investment models, subject to a whole host of ES constraints. And these are usually exclusion restrictions. You can't invest in this and that and the other, which is really quite different from how we in the academic literature have been modeling sustainable investing, which was traditionally all about an objective function that's a blend of financial returns and ES performance. So the way we've been modeling it in the academic literature is we have investors or asset owners who put 60% weight on financial performance and 40% weight on ES performance. Now that model has really very different implication from the ones that I think we see in reality, that we see in industry, which is all about, no, forget about that. Maximize portfolio value, but in a constrained set. And for us academics, it's a bit of a call to arms saying, we need to understand this model a lot better, and we haven't been analyzing it at all because we've been focusing on the wrong model. Okay, that was the academic side bit. Let's go back to reality. Final set of questions, and I promise I'll shut up in just a moment, is all about actions. And we asked a series of questions about stock selection, portfolio composition, voting, and engagement. So let me just show you one, which is about stock selection. Do you underweight poor ES performers or overweight good ES performers for any of the following reasons? And again, because this was towards the end of the survey, we kind of just dumped everything in there. We kind of worried that people would really lose their patience with us. I was actually amazed by how good and patient the portfolio managers were. If you remember, 479 of 509 made it all the way to the end. In all honesty, they're better than I am. I would have given up. Once I see a table like this in the survey, I usually walk away. But people stuck with it, which I'm really appreciative of. And again, the message here is very, very simple, that yes, fund managers do take ES performance into account when selecting portfolios, when picking stocks. So if you just focus sort of on these percentage numbers here, which is basically all of those who said sometimes, often, very often, we're getting lots of very high percentage numbers here. For the traditional investors, the number 1 and 2 reason to do it is to avoid downside risk and to improve returns. Notice those are purely financial motivations, right? So this is really very much, again, about we believe that ES performance is financially material, and that's why we're taking it into account. For the sustainable investors, unsurprisingly, we have these 2 motivations, but the most important ones are to be consistent with our company's policy, with our clients' values, and with our fund mandate. So again, the constraints on the fund manager kicking in very, very hard here for the sustainable investors. All right, so with that, let me quickly summarize and conclude, and then we can move on, and you can all grill me and tell me what we've done wrong. So I think one of the real big takeaways from our survey is that traditional and sustainable fund managers are not as different as you might have thought. Well, without projecting onto you, certainly they're much less different than we thought before doing the survey. So both of them prioritize financial returns. Both face ES constraints that affect their portfolios. Both view at least some ES issues as material. Both tilt their portfolios based on ES performance. Both engage with companies to improve with ES performance. I didn't show those results with you, but they're very much in the survey. And maybe somewhat less positively, both believe that current ES performance of companies is already quite close to the value maximizing level. Now, there is huge heterogeneity in the beliefs about the materiality and returns of ES performance, which really just once again means that you can't trust fund labels. In the sense of you might buy a sustainable fund, but you might have a fund manager who doesn't actually believe that good stocks will outperform. Instead, you might be buying a traditional funds, and you might have a fund manager who very much believes that good ES performers will outperform going forward. And that will very much be reflected in how they will be investing. And finally, and probably I shouldn't be finishing on a bit of a downer, but let me do it anyway, being German and all. I think there's some cause for pessimism here. Look, if we're in a situation, remember how we started out. We said, will the asset management industry, will portfolio managers help improve corporate ES performance? Now, if we're in a world in which asset managers, including the sustainable ones, still prioritize financial returns and at the same time believe that current ES performance of companies is already very close to value maximizing levels, then the answer sort of has to be no. Right? Asset managers, portfolio managers will not be manning the barricades, shouting at companies to improve their ES performance because, well, they're still trying to maximize financial returns, portfolio value, and they believe that companies are already pretty close to value maximizing levels. Thank you so very much, and I'm looking forward to your feedback and comments.
So Dirk, thank you so much. Do come and join us on the panel. So what we're going to do now is get some discussion comments from our 2 practitioners who will, as Dirk says, tell us everything that we got wrong. Catherine.
There isn't time to tell you everything.
We'll set up another session for that.
Thank
Catherine,
you.
please, you start.
I mean, I had written at the start that it's really uplifting to be here, but you did finish on quite a downer. but it is nice to see so many people here at what is actually quite a depressing time to be a practitioner. And that sort of brings me to my first observation, that this survey is capturing very much a point in time in an industry that has been very rapidly changing. So we've gone through this huge hype cycle in sustainable investing. We're now in what Gartner would call like the trough of disillusionment. And I wonder how different this study would have looked if you'd done it a year or 2 ago, or if you did it in a year or 2 more, and maybe there's potential to repeat it in the future. But certainly, I found it quite difficult to fill out, not just because the tables were long, But being very explicit about your beliefs, making them internally consistent, and in an environment where you have clients who can potentially fire you for doing too much and also doing too little. I wonder, surveys are always risky in that how many people are reporting what they actually believe versus what they feel they ought to believe. So that was kind of one thought, and that was why we all got so antsy in the free text sections too. The heterogeneity point, to be honest, I found it surprising that the academic world found that surprising. Because I don't think it will be a surprise to any practitioners who've worked in the field for a while. We kind of open our presentations by saying, there are as many definitions of sustainability as there are funds, or possibly more. And I think to a degree, that would be the same of any category of investing. So like growth investing, value investing, people will disagree on what it means, and that's what makes a market. Though I was quite intrigued by the 9% of sustainable funds that don't factor ES into their stock selection. They're not getting a label. And I think it's a big challenge for empirical studies, and this is kind of something that I've run up against through my career, is people saying, but does it work? And in fact, Professor Dasgupta sort of referencing, does sustainable investing work? I'm yet to see a study that I feel is decisive in either direction, because you can only measure something if you can define it, and everyone's defining it differently. There's a huge difference between an approach where sustainability is a necessary or sufficient condition for investment. And in fact, one of the things that maybe, I don't know whether you guys tried to pull out, was people who ran dual objective strategies, so impact strategies versus sustainable ones, where there's much more of a sort of legitimate trade-off. I'm not going to go into a rant about regulation, though I can over drinks later, but you mentioned fund labels and how out of sync that is with the degree of heterogeneity here. And I understand that regulators are trying to make it easier for clients, but the temptation is to rely very heavily on the kind of hard, objective stuff, which just tends to reduce everything to the lowest common denominator. And as came through in all the comments, how we treat different factors depends on how material they are to a specific business, rather than just whether we're box ticking. And I think in particular when you think about returns, the obvious stuff that everyone reports and everyone looks at is now going to be priced in, if it matters at all. Whereas the alpha, I strongly believe, comes from like the qualitative work, the relationship building, the like soft stuff like corporate culture, which you can't like run a passive fund on. And I think there's a risk in our industry that there will be a trade-off between trying to achieve simplicity or transparency and actual client outcomes. And the last thing I wanted to comment on was the alignment. I think I prefer alignment to constraints. And I think the challenges around labelling and the sort of politicisation of the space mean that this is more important than ever. And it's fair to assume that there's the same heterogeneity on the client side as there is with practitioners. So there's some papers reference, we say asset owners care about E&S, but what does that mean? And my sense from working with clients for coming on 20 years in this field is that a lot of clients want to kind of be invested in a portfolio they can be proud of, where they like personally, especially sort of family funds, charities, endowments, etc. I think it's described in some of the literature as the warm glow effect. And there's also an element of this for managers. I thought it was really interesting that you didn't ask about managers' personal values in the survey, because we were also scared about fiduciary duty. But that's why we've chosen to work in this particular field, generally. So I don't think you can take values out of this debate. And I think also it came through a little bit in the question on carbon emissions, where people said they had a distaste for investing in stocks that harm society. That might be the closest you got to kind of true preferences coming through. And ensuring that alignment is really, really difficult. Like for big clients, we can have the conversations with them, but beyond that, I think all we can do is be really, really transparent about our beliefs, our values, our process. So we put I think most managers do now, show all their stocks, why they hold them, the explanation, and sort of say to clients, look at this list, and if this doesn't gel with you, then this is not the fund for you. But you can't really do that with a label.
I'd like to just follow up. Thanks very much for those excellent comments. I just wanted to follow up the point you made at the end around this question of sort of showing your beliefs to clients. You know, if we are, I mean, asset managers often say to me that, oh, well, clients say they want all of this stuff, and then they come along and do a quarterly review and say that I'm, 10 basis points off the benchmark, and then that's suddenly a problem. Are you seeing developments in how you're handling that question of sort of trade-offs and beliefs with fund managers? I mean, are you doing that? Are there side letters? Is it getting built into mandates, or is it just how you articulate your frame of reference to them? Is anything changing?
I don't think anything's changing for the better, particularly. Right. I think we're trying to be more and more explicit about what we believe, because the worst sort of case scenario is that you end up with clients in a fund who sort of didn't get what they paid for, right, or thought they were getting something different. But I'm not really seeing anything particularly innovative in that front, so I'd be interested if Ben is.
Okay. Yeah.
Well, I have a couple of client and stakeholders who have the equivalent of a memorandum of understanding, a kind of a fund manager accord, which isn't a legal document. It's kind of maybe like the preamble you get before a constitution saying, this is our view of the world, these are our values, these are our purpose, and to the extent that you should take this into account when you're thinking about investing. And I think that's one way around it, or to have an influence on that. It doesn't breach into this fiduciary duty argument, because it's that. And I cover a couple of other stakeholders where, in fact, we tried to do this with a number of our clients with that, where particularly if they're representing an organization or an institution which has their own purpose and values and strategy, and yes, we might be managing their money on their behalf, or even on behalf of their beneficiaries or stakeholders around that. But if that organization comes with its own corporate purpose or business, then taking that into account in how you think about it, and it should have come up with an investment beliefs and all of that, I think is an important reflection to the extent you could do that, and should probably have in that discussion about what a mandate is and what your beliefs are. But if you wanted to express it in some sort of writing, this side letter or memorandum, I think is a possible way of doing it.
Interesting. So what else did you have to say?
Yeah, sorry, I think all the good points.
A few ones. First of all, I don't come with any organisational endorsement. I should probably say that if it's recorded, just in case anyone thinks I ever do, which I don't.
Not even from RBC.
The one of the kind of joking surprises, I can't believe that's what academics thought as the standard model, because if you asked anyone in investors for any time, they would have said, like, that's obviously not what investors do. So this disconnect between academia and practitioners is a lot of work to do. Isn't this the joke between like the map and the landscape, and use the map to navigate the landscape? But you could have, in this case, just asked the landscape, and I think you would have got a very strong consensus that that's not how we think about things. But yeah, I thought it was really good to ask, even though it's just one time of that, because I do think there's a tendency in some in academia to just rely on these models. And you sometimes put all of these assumptions up before you do the models, and you just ask any practitioners, well, assumption number one is just wrong. So everything which follows in the rest of this paper is just wrong from that start. Obviously, you need to simplify it with that economic thing. And I would pick up on that, thinking about the surveys. I think more and more about revealed preferences versus expressed preferences. Actually, you see this within consumer preference literature on green resources, because consumers say, oh, we will buy green. And then if you look at whether they do buy green, they will buy it if it's up to maybe a 10% premium, but they won't if it's a 50% premium, say, on average, even if they say they will. So there is this difference between premiums or not. And I thought, reading through it and things, I did think there was an element to be cautiously optimistic on some points. One was that some of this is kind of being considered like any other sort of factor. So, for instance, who in the room thinks return on equity is an important factor that you should consider in company financial analysis? Hands up for return on equity. So most people would think kind of return on equity, right? But then you could say, is return on equity important for a biotech company? Who thinks return on equity is important for a biotech company? Hands up.
Terminal return on equity.
Well, okay, well, for that. But not very many, right? So you get something where you have a consensus that's important, applied to a very big sector, like biotech, which doesn't make any money. Return on equity generally doesn't make any sense, and biotech analysts will not look at it. So in the same for some of these things, I do think some of that also comes up. And the same for something like R&D productivity, not important if you don't do any R&D, right? So there are these kind of things which still don't get to some of that, which I think would be maybe interesting to explore. Some of the other things I think would be interesting to explore, given you had that, is maybe some further split. So I know you concentrated on active managers, but actually a lot of the world is passive and quant. So with my quant frenemies, it would be really interesting to see what they thought as well, because they have a different way of doing that, and whether there's any differences between that. And then you can have all of these other expressions. So, I mean, who in the room thinks so-called, we can argue about the definitions, who thinks value investing is going to work? Hands up. Few for value investing. Who thinks growth investing is going to work?
I have to or I'll get fired.
Okay. So not many for growth investing. So you have this, can you be a value investor, a sustainability investor, and growth investor? And if you self-define as value, is it different or not? And I would say the kind of heuristic tends to be that if you are so-called quality growth, you pay more attention to this, and if you're so-called value, you might pay less attention to this. But it's actually by no means is completely contested, as those original terms are, as it is contested as over the next 7 years, whether the value factor, either done in an active way or a quant way, would work or not. And I think that would be really interesting to explore. And then there's those other things, US, EM, geographic. Again, the kind of heuristic is maybe EM is a little bit less efficient and EM's got a little bit further to go, so maybe this might be more important. Again, that's an anecdotal heuristic, which I think would be quite important to explore. And the other one is then actually different asset classes. So I see I have some infrastructure friends here as well, or private equity friends. But again, how does that relate to infrastructure? And that gets to another really important point, which actually segues a little bit from some of the initial points that were made right at the beginning for your actual theory of change. And that's between primary and secondary finance. So most of this was in secondary finance, as in other people are giving shares to one another and not doing primary finance, although we might do a little bit of IPO and secondary, or our firms might. And there may be a well-differing view on that. And it's the same on the debt side. And it's also the same for debt primary versus debt secondary, which then intersects with the second primary theory of change that we might have, which is on active stewardship into activism, say, and how that also relates. And you had some questions within that influence you would have with some of those channels. But for those in secondary investing who really believe in that, active stewardship is one of our real primary levers, because actually we don't think we're necessarily impacting cost of capital necessarily that much, although, again, quite contested. And within that, you could also do some beliefs. And the last couple of points I thought were quite interesting or didn't come out is there's also a lot of heuristics within the market. Actually, this is quite well explored about whether it's the change, or what we would call the delta, or whether it's the level which is important. So, and there were some allusions to this. So whatever you think is bad, if you go from bad to average or average to good, is there outperformance in that? Or is it the absolute level, because you want to be good, but good can also get better? And there's a lot of basically debate as to expectations within that, change of expectations, rate of change of expectations, and how that intersects with that belief. And I think that you might actually get a consensus about wherever that you might be within that, if you have a very big material delta, if there was a consensus on that from wherever you would be, and that wasn't necessarily spotted by the market, then there might be a lot of alpha associated with that. And actually, arguably, whether that's from a behavioral or whatever point of view, some quant people are going for that from their way of looking at it, as well as some active people. And so the exploration of potentially the delta or the change or change of expectations, and obviously expectations are obviously impacted by all of these other factors, so that gets to the heterogeneous and another part of that. But I kind of could take a cautiously optimistic take on some of that. Obviously, you're working within the constraints of where you are, but also if you believe that companies, or even be it markets, are essentially some sort of reflection of a conglomerate of society preferences and human preferences, and where the long-term things of going that, then companies which reflect their stakeholders, consumers, employees, shareholders, and markets which are reflecting that, means that good companies get better and do well, bad companies or companies which are irrelevant go bust and bankrupt and they no longer exist, which is why we're using this concept of transition. And you do that within the frame of the rules of the game, on whatever the social policy or the constraints there. And if there is this movement with that and markets move towards that, then actually there is no reason that we wouldn't move that. You can argue about the speed of transition, but essentially I think that's what would happen and what's maybe being pointed to there. I'll end that.
Ben, thanks. Fantastic comments. I'm going to open it up to the floor for questions, but just whilst you're thinking about those, Dirk, anything that you particularly wanted to pick up?
First of all, just thank you so much for these absolutely fantastic comments. Lots of food for thought. Without wanting in any way sounding at all defensive, but
that's like in English we say with all due respect. No one really is like, yeah.
It would be in many ways, it would be really concerning for us if our results would be surprising to the two of you. Because in some sense that would mean we would have gotten it wrong, right? This is us academic eggheads trying to figure out how the real world works. In part motivated by working with Tom, who has a much better insight into the real world than Alex and me. But even Alex, who's been working with asset managers for many, many years, sort of has a pretty good understanding. So we had a strong inkling that the way we've been modeling things, approaching things from the academic side were wrong. And we thought, what's the best way of actually demonstrating that and getting that into the academic literature and getting the other academics look at that is, well, let's go out there and actually just talk to people, right? Because, I mean, a survey is a fancy way of let's just go ask people what they actually do and what they actually think. So in many ways, if you were surprised by our results, honestly, that would mean we probably mismeasured something. So if you're telling us, yes, that's obvious, we knew that already, it's kind of very reassuring. We actually measured how things actually work, and now we get to speak to the other academics and we get to tell them, let's do things a bit differently. Now, the only other more substantive point that I'd like to pick up on, because I believe it's so incredibly crucial, and it's something that Tom, I, and Alex have been talking about a lot, is this notion of alignment between the asset managers and the asset owners, the clients. Right? Because ultimately what the asset managers sort of should be doing, I guess in a normative sense, is to reflect the preferences, beliefs, and anything else that their asset owners, their clients, want them to do. And now the big question that we're trying to wrap our head around is whether the current model that we seem to sort of have documented here, and that you're telling us, well, we knew that already, which is value maximizing funds, so portfolio value maximizing funds, subject to an array of ES constraints, and then lots of differentiation across funds, different constraints on different funds, and then clients sort of picking their funds and matching them to it. And if you're an institutional client, talking to the asset managers and saying, here's the bespoke product we would like. How close are we getting to actually reflecting the client's preferences? And sort of to not pre-announce anything we haven't done yet. Tom, Alex, and I are thinking about doing another survey with the clients, with the asset owners, and in many ways asking them, how happy are you with what your asset managers are doing? Right? And we just had an interesting situation where Tom mentioned it before. Actually, I believe Amil mentioned it, where the People's Pension Fund pulled 28 billion from one asset manager because of a misalignment. When I saw that in the FT, I was very surprised because I was thinking, well, for 28 billion, can't you get your asset manager to do whatever you want? And why did that not happen here? So I believe there's lots that we still don't understand. Again, just the academic speaking here, that we still don't understand about this relationship and how this alignment actually works.
I'm going to open it up to the floor for questions. You just raise your hands. I'm going to take 3 questions. Just start with the person in the middle of that row there with the blue top. Sorry, my varifocals don't stretch to, I'm going to use vague discussions. And actually, might as well go from there to there. And then, let's start one right at the front. The front always gets missed out. Okay, so we'll take those 3 questions at all, please. Yeah. And please just kind of state where you're from and then a brief question, please. Thank you.
Hello, my name is Harak. I'm currently doing MSc in Financial History at LSE. And I really loved the entire research. It was quite insightful. And I had 2 questions quite focused on the research itself. One was relating to the fact that when we discussed about when we asked the managers about the trade-off between the ES performance and financial, like the return performance, and we see that the most popular response is like there's no need for a sacrifice in financial returns. My question is that when we actually spoke with them and we see that they say that certain actions towards improving ES performance would not affect returns, a lot of them, are they more social in nature or do they include environmental as well? Because things that are more related to the culture, how we treat the employees, suppliers, seems more social in nature to me than environmental. So do we see a difference there that the environmental do have a more financial trade-off requirement as compared to those that are social? And just a quick second question is how we ended on this pessimistic note of how we believe that ES value will not necessarily improve through this sort of sustainable investment. Can we say that the ES constraints on these funds play a big role in this? Because if we are already investing in like assets that are of corporates that have good ES performance, if we move our investment towards corporations that have potential for better ES performance, which could be like a current constraint to these investment managers, would that allow us to say that the impact can be achieved?
Thank you very much. Yes, I think that's James over there, is it? I definitely need an eye test.
James Alexander, Chief Executive of UK SIF, the UK Sustainable Investment and Finance Association. Thank you for the study, and it's really interesting to have this lecture. I wondered what my question, I suppose, is about risk and the extent to which, obviously, risk, of course, is the driver of long-term value creation across a corporation, regardless of whether it's E and S or any other sort of risk. And how did you factor in the fact that just a standard corporate risk analysis should incorporate environmental and social issues, and that is what ESG investing is fundamentally, or sustainable investing is fundamentally all about. And of course, when we think about risks, we also think about that in the context of impacts, which over the longer term, an impact becomes a risk. The gig economy, I think, is a classic example of where you can't just keep on having a negative impact without that becoming a risk. And so how much do you factor that risk piece and just standard investor analysis of risk into the research? And then the other sort of linked question is...
I'm going to stop you there, actually. I'm not going to allow everybody to have two questions.
Okay, thanks.
We have another question at the front.
Thank you so much. My name is Kim Kramer. I'm an assistant professor in the finance department. One huge challenge with sustainable finance is that capital flows to emerging markets or the global south, and there are certain funds that are specifically targeted at that. So my question at the practitioner is, do you think that the role of these funds is growing? Do you think they have a role to play, or do you think we need other solutions for that reallocation?
Okay. Right, I'm going to direct some of these. Dirk, I'm going to ask you to go for the first two questions, first of all, right? So when we had followed up with managers who said there was no trade-off, is there a particular type of environmental or social issue that seemed to explain that?
I think the best evidence, it's a great question. I think the best evidence we have on that was actually came from that other question where we asked, do you think companies are already doing too much, too little, or about right on these 8 different dimensions? And there the message was pretty clearly that companies should probably be doing a little bit more on, or about right, or maybe could be doing a little bit more on the social side, so especially customers and employees. We did not get a lot of support for doing more on the environmental side, right? And the one dimension where genuinely there was a bit of an agreement that they're already doing too much was greenhouse gases. So there's a clear, I think, perception in the investment community that on the social side, there's still a bit of room to do, but not so much on the environmental side.
And so then the other question was then about the pessimism. So if these ES constraints seem to work, can't we just do better constraints?
That's a great question, and I think that's sort of really what we're trying to understand at this point, right? Sort of why is the asset management industry organized in that manner, value maximizing plus a whole range of constraints? Is there an alternative model? And in all honesty, given that so many extremely clever people are working in this industry and are trying to serve their clients and are competing for clients, Sort of as an economist, I'm naturally inclined to think that is the market solution to whatever agency information and other problems we see out there. That might just be the best way of doing it. And alternative approaches might be problematic. But I think that's literally the research frontier that we are currently at, exactly what we're trying to understand. So maybe if you ask us that question again in 2 or 3 years' time, after we've really been doing the work here in the Sustainable Finance Center, or initiative it's now called, I believe, the Sustainable Finance Initiative, hopefully we'll have a slightly better answer.
I might quickly, do we have time to quickly add?
Yeah, you can quickly add. Yeah, I'm going to come to you with a question as well. I'm going to send one over your way.
I would just say on the E versus the S front, a little bit is to do with externalities and spillovers. So if you're working just on your employees, you can more easily say, okay, this is benefiting the company. Yeah. When you're working on a greenhouse gas, you're benefiting the world. And so there's complications around that. There's also complications about your theory of change, about whether you signal by being a leader, and the leader is, if you want to run fast, you run with a whole group of fast antelopes, or you deal with a laggard and you're saying the laggard's going fast, both of which are contested theories of change. And the other one, which is kind of the risk versus opportunity, there is something else that we said, okay, you may be managing environmental risk, but are you innovating, and this was the other thing, to reflect where consumer preferences or your business preferences win? And that might not always be captured in this kind of question, because that's the opportunity side when you're investing in R&D or new product development of that. And actually, for a lot of managers within this space, that opportunity side is actually just as important. So I know a lot's been going on about the risk, but actually the way you kind of grow and develop new things is often about the technology, the opportunity, the transition, the consumer, or the like.
So you've also answered James's question, which is fantastic. But I'd like to come to you then, Catherine, for this one around how you view emerging markets funds, right? So, the question was here, I mean, there's a growth in funds that are seeking to allocate capital to emerging markets in the global south. Is this an important part of the future for sustainable investing and having impact?
I think there's it's a necessary part. We know that there has to be a huge amount invested in the global south if we're going to reach our environmental and social goals. But I'm not sure, honestly, that the private market is serving that particularly well, or is going to allocate as much capital as is needed. I think where you see the most sort of proactive allocation is more in impact strategies rather than sustainable strategies. I think sustainable emerging market strategies, I think, are relatively rare because the way that the EM benchmarks are structured, it's very hard not to own oil and gas or extractive industries. And again, most clients pay you to deliver a return first and foremost. And then there's kind of debates over what is the right level of governance, etc. So I would like to believe that there are ways we can channel more capital to effectively solve those problems, but I don't think we've got the right setup currently.
That's why we've got the Blended Finance Lab. So, thank you very much. Fantastic comments, discussion, presentation, remarks beforehand. Thank you all for coming. It feels premature to curtail the discussion here, but I did promise to finish at around 8 o'clock. What we've tried to do here this evening is to demonstrate what the Initiative for Sustainable Finance is really all about, which is combining academic rigour with practitioner insight to come up with better answers for how we create the incentives for the private sector to fund a transition to a sustainable future. Please do stay for drinks and canapes afterwards. Thank you very much for your attendance, and let's thank our speakers.